Hey, Carl, how are you, sir?
Great.
Yeah. Well, we do have a special announcement to start this weekly sense. I know we haven't done one in a while. We've been a little busy, but we do have someone special joining us today and hopefully in perpetuity until eternity ends. I don't know if eternity does end.
No,
Um,
it doesn't.
but who we have today, we have a new portfolio analyst who joined our firm about 3 weeks ago now, almost a month. His name is Luke. Luke, are you there?
Hi, everybody. How are you? Thanks for the introduction. Very nice of
Yeah.
you.
Welcome, Luke.
Welcome, Luke. Look at
Pleasure
now
to be here. Thank you.
it's three of us. So now we can meet in the middle on a bunch of different topics. Some of the things we want to discuss today, obviously the Fed was last week. We had inflation this week. We also wanted to talk a little bit about what's going on year to date in the markets, how those returns are developing with the indexes, and then obviously end with the debt ceiling. So let's kick off first by the Fed. So the Fed raised rates by 25 basis points. Some didn't think they were going to do it. Some think that maybe they're tipping us too far. And it may be too much. I think Bill Ackman's in that boat. We've had a number of banking crises. What are your thoughts, Carl, on just the overall position that the Fed's in right now?
I mean, I don't think they really needed to do that rate hike. I mean, they've created enough monetary tightness as it is,
Mm.
and you can see that from the bank failures that have happened. I feel like they did it mostly just to kind of project the image that the bank failures aren't such a big deal that it prevented them from doing another hike. So they went along with it. It probably is the last one. Markets aren't expecting much more or any more. So we've been looking at all that and working on starting to extend duration in our T-bills. What do you think about all of that, Luke?
Well, it is kind of interesting just because I think the language changed significantly. I mean, this definitely looks like a pause. I think you're seeing the probabilities as far as a rate cut. I think that's kind of increasing out to what, September? We're
Yeah.
starting to see that. So this was a pretty marked change.
Yeah, they've done a big job already, right? 0 to 5 in what, 13 months or so? Something like that. I mean,
Right,
that's a
second
pretty big move.
fastest tightening cycle ever.
Yeah, and it generally takes what 6 months or so for the economy to really feel previous hikes. So right at this point, the economy is really only feeling like 3 or 3.25% federal funds rate theoretically, right? Um,
Right.
that's what it
We'll
was
see
about
when the
6 months
cuts
ago.
start. I mean, the market's expecting rather soon. We'll see. I mean, they've been talking about keeping the Fed funds rate higher for longer. If you go back and look, typically, I mean, it can vary a lot when the first rate cut happens,
Right.
but often you have a period of 6 months to a year before between the last rate hike and the first rate cut. But it's looking like it may not be that way this time, and maybe because we started having bank failures already. So
Sure.
we'll just be watching that. But we wanted to talk about a number of things today, including how much the market's done. Equity markets have done decently well so far this year. Nothing in our view has really changed, although there's a lot of market concentration, especially among large tech companies like Apple and Microsoft.
Yeah. Yeah. Before I get to that, I want to finish up with the Fed and interest rates. So a big thing on what the Fed may do inevitably is going to be determined by how much inflation comes down, right? So if inflation remains sticky like it kind of has specifically in that core portion of inflation, which is really service driven. And remember, Dan Niles came out not too long ago and actually said something really interesting about the stickiness of inflation. So core CPI is really driving the sticky portion of inflation right now. And services have a big input on that core CPI. And there's a huge imbalance on jobs outstanding in services that need to still be filled, which could keep that core CPI or that services segment elevated for longer, which could, make the Fed, act one way or another. Because if inflation stays around this 5% level for a significantly long period of time, they may have to do a little bit more tightening. But yeah, we did just get CPI data yesterday or Tuesday. It was a huge drop, guys, right? I think it went from 5 to 4.9.
4.9 came in. Well, one of the things, quick, Andrew, is that too on the services side, this is the first time that I've actually seen some positive movement in services. So that was kind of encouraging for Powell.
Okay.
And also one note, just is the ECB is still kind of in hiking mode over in England. So it's, if you start looking at kind of this correlation between global central bankers, it's really interesting that Europe is actually still in a hiking mode right now.
Right, where we're getting this disconnect between the different countries based off of what's going on. But I think in the UK, they still have like 10% inflation.
Right, they have more inflation, and maybe they will continue to have more depending on what goes on with energy over there in Russia, right?
Yeah, and you have to remember they're no longer on the euro, so that pound is probably not helping with the inflation problem, basically going over to a new currency. Okay, so inflation came down from 5 to 4.9. Not a significant drop. It didn't go up. I guess that's good, but that does make the case for higher for longer, right?
But the bond market, interestingly, actually reacted positively to that, and yields fell a little bit. We'll see if that continues, but that's what's been happening.
Yeah. Now to pick up on what Carl was just saying a little bit earlier, so I think the S&P 500 is up about 6% or so far this year, somewhere in that range. Someone put out a chart earlier this week that showed the overall constituents of the Russell 3000. And I think the average rate of return for the stock, or the mean, I guess I should say, in the Russell 3000 is about -2.25%. Yet the index, like the S&P 500, is up about 6% or so for the year. So there's a chart that I just wanted to share because this is pretty drastic. The disconnect. You can see this, right, guys?
Yes.
Yes.
Awesome. So what this basically breaks down is each individual sector in the S&P 500, technology, healthcare, financials, so on and so forth, all the way down to real estate, how much of their makeup is in, or their weightings are in the S&P 500. So 26% of the S&P 500 is in info technology. And of all of the constituents, the individual constituents in the S&P 500, two names, Apple and Microsoft, make up, roughly 14%. So the other 86% are the other 498 names. Any thoughts on this, guys?
Yes. I mean, it doesn't happen very often. It's kind of unhealthy to have high concentration. You can see Apple and Microsoft this year have been really holding the market up. It's something that happens once every 20 to 30 years. The last time it happened was in the late 90s technology bubble. The time before that was the late 1960s, early 1970s. People talk about the Nifty 50 and companies like IBM and Xerox and Polaroid, and how they didn't do well subsequently. And a lot of the tech leaders in the late 1990s didn't do well subsequently. People have been talking about that, though, here for years,
right?
And it continues to go on. That's the biggest challenge.
Yeah, well, they continue to
so
produce
you would
results,
think that
right?
You would think that with higher interest rates, there would be some change with that. There hasn't been yet. Typically, it happens when you get the end of a business cycle, and we're not quite there yet. But history would say that the past leaders will be underperformers over the next 5 to 10 years. But we'll see. I think it's going to take the bear market continuing to play out and the economy worsening.
Yeah.
Well, it's a little disconcerting when you're looking at companies like Apple that are trading near a 30 forward multiple, that are reaching, and then that really is the strength of the market. And if you're looking at some of the different sectors, even on a technical basis, they're breaking down. I mean, these stocks are getting weaker and weaker, but the market just kind of staying solid just on this handful of stocks that are trading at really high multiples. So it's really disconcerting.
Yeah, it's almost like the inverse of what happened last year, right? So people fled technology and hid out in those consumer staple stocks for the large majority of the year, push those valuations up pretty high. Now you're getting the reverse, where you're getting, basically the top 5 names are now like the safe haven place to be. even though from a valuation standpoint, an earnings growth standpoint, a revenue growth standpoint, doesn't really justify where some of these valuations are. Yeah, I mean, you look at something like an NVIDIA that trades at like what, 60, 65 times forward PE, or like 20 times sales. Isn't it something like that? I mean, there better be a huge boom in the near term future in AI to really bring those numbers and those metrics back in line. But it just shows you that if you have any kind of potential weakness in any one of those individual names, the rest of the market is basically saying, hey, we're kind of sick down here, while the rest of these, top 5, top 7 names are really pushing the market, to where they're at today. But again, what I get back to when we talk to clients is if the S&P 500 is only up 6% or so for the year, you have all of that inherent earnings risk behind it for owning that index in an environment where you can get, 4% or so, if not higher, in U.S. Treasuries. So speaking of U.S. Treasuries, anything you guys wanted to add on either of those topics that I just said here on the components? Nothing?
Nope.
So speaking of U.S. Treasuries, Janet Yellen has basically come out and said, please, give us money. We're going to be in trouble come June 1st, I think is the date.
Yes.
I believe both the leader of the House as well as the leader of the Senate came out from a meeting with President Biden yesterday. They both said completely different things. So that's one thing that we can count on, that neither side of the aisle can really agree on anything. So I don't know how close we are to getting a potential deal done. I think it is pretty foolish to allow us to default. But I understand, both sides of trying to get something accomplished, whether it's from a budgeting standpoint or from a fiscal standpoint of trying to get a little bit more fiscally balanced. But we did a little bit of research on the last time that we defaulted, which was 2011. And I think the S&P 500 dropped 23% during that period of time, somewhere around there in the low 20s. Treasury spiked as far as the prices or yields fell pretty drastically. But there is a big difference. Right now we've got 5% inflation, where I think in 2011 we were running under 1%. So what is everybody's thoughts on opportunities that we're looking for through the debt ceiling? Maybe some of the consequences that could come. Is this the one thing that is that extra spike of volatility that really makes us take a look at, everything that's going on in the S&P 500 for the year? Let's just kick some ideas around.
Yeah, I mean, it probably will be an event that will result in some volatility. We don't know how much. There might be a pullback that would give us a buying opportunity in some of the things that we've been watching and looking to take some risk in. We don't really know what's going to happen with Treasury yields.
Yeah.
The Treasury market is reacting, and there's a gnarly distortion in it right now where the Treasury bill due June 6th is yielding about 5.4%. And the ones maturing at the end of May are yielding around 3.5%. So, I mean, you can scoop some extra yield up for a month. But people are genuinely worried about this, I think, because of the degree of partisanship and the dialogue out there. The fact that the Republicans may try to hold things up to really accomplish something here.
Right.
But I mean, based on history and what happened in 2011 with the ratings agency downgrades of the U.S. losing its AAA rating, we feel like it's a little more likely that bond yields will fall, but something could go awry and they could rise. And we've been discussing that as maybe a potential buying opportunity if we get enough rise in the intermediate Treasury maturity zone. Or maybe even the long end. We'll just have to see how things react.
Well, that's kind of what's a little bit tricky right now, because we're not really seeing anything overridingly telling us one way or the other. I mean, if you did get a downgrade in our paper, that could potentially cause yields to rise, but there's nothing to say that it wouldn't happen like last time where yields fell and then Treasury prices rose. So there's no real clear indication, and that's what makes this a little bit more challenging right now. And it's best, but there are potential, we have our wish list of what we would like to see happen, but there is no overriding metric that's telling us, was really giving us a huge clue this time.
Right. It's going to be really strange and unpredictable if there actually is a default. We don't really expect that. We think there's a pretty low probability, like a low single digit probability of something like that. But I'm not even sure what exactly that would look like. Government employees wouldn't be getting paid for a while. What about that Treasury bill that's due June 6th? If they default, are they going to pay that? How's that work?
Yeah, well, that's why any kind of short-term paper that we're holding, it matures on the 25th.
Well, I think we talked about that earlier too, is how much Treasury debt is maturing over this summer.
Yeah.
I mean, Andrew, I think you said that number earlier today. I mean, it's ginormous how much money, how much is coming due and how it needs to be rolled over.
It's like $1 trillion.
Yes.
And it's not going to be rolling over at that 0.5 or 1.5%. It's going to be rolling over at,
5,
mid
4.5,
mid 3 to 5. Yeah. Yeah. I mean, fiscally, that's not good. So, all right, guys. So look, Fed came out, they hiked rates, probably going to pause from our standpoint, higher for longer if inflation remains as sticky as it is and it's not declining as much, which puts more pressure on banking institutions. High concentration in the S&P 500 is really what's driving it. The underlying constituents outside of the top 5 are actually not looking as healthy. Sector breakdown. A lot of sectors are breaking down outside of the XLK from a technical standpoint, and low probability of a default. But if that happens, it's really unknown what's going to happen with Treasury bonds and their yields based off of history and kind of how everything's shaken up, right?
Right. Well, I mean, we've had a downgrade before, but we've never had a default. So it probably won't happen, but I mean, we'll see.
Anything you'd like to add in closing, Luke? This is your first one, man.
Well, it was fantastic. I like being here. It was a lot of fun, and looking forward to doing this again.
Awesome. All right. That's Weekly Sense, everybody. Talk to you guys soon.
Thanks for joining.
Bye.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.